Good morning, everyone. It's good to be here. Uh, I think my colleague Vinu will begin.
Yeah, hi. Morning, everybody. Thank you for joining us today. My name is Vinu. Along with me, I have Samyuktha here. She's our principal strategist. And today we're excited to be leading this discussion on gold. So it's an interesting day to be speaking about gold today. So we've seen gold hit an all-time high price today. So this might have brought the question of whether it makes sense to invest, given that it's hit an all-time high. Is this the right time? Is it too high? Should we wait, or should we consider other asset classes? So all of those questions we hope to address through this webinar. So historically, gold has always been considered as a symbol of wealth and power. It has also been seen as a reliable a reliable store of value through economic cycles. It's known to store value against inflation. So we'll be looking at what is looking interesting in gold today as an opportunity and why it is an essential component of your investment portfolio. So before we dive into points like inflation hedge or long-term performance of gold, we'll look at a little about the history of gold. So we'll dive into where gold began and what it is today. So we'll start with the California gold rush. So this dates back to 1848. So this was back when California was just a desert. It only had trees, barren lands, and mountains. It did not have a lot of population back then. So this is when gold was discovered in the US in this riverbed called Sierra Nevada. So hearing this news, a lot of people started rushing towards California. So back then the population was around 1,50,000 people. So seeing that gold has been discovered, a lot of people started going in search of gold. And after this, a lot of people started migrating to California in search of gold. So all the search was eventually to become rich. So around 30,000 new people had migrated to California as gold seekers. But history says that not most of them became rich, or most of them returned back disappointed. A funny story is that these mining require to mine these golds. It required a lot of these pans and shovels. So it is said that these businesses who sold shovels and pans eventually ended up making more money than the people who went there to seek gold. But this was the beginning of the advent of gold. Now, and this is again a very historic moment for USA, because this is what led as a catalyst for California that we see today. So back then it was just a desert and barren land. Today it's the most populous and the richest US state. Next, we move on to the Bretton Woods Agreement, which was a big move for gold. So after World War One and World War Two, countries were in shambles. The financial system in general was in shambles. Countries had printed a lot of money, and that had led to a hyperinflationary situation in a lot of these countries. So prices of goods were rising very, very fast. So countries needed a new financial system in place, a stable one. So that's when countries gathered together with their own delegates and decided to fix gold as a reserve. So at that point in time, US had close to 75% of the world's gold reserve. So dollar was eventually decided to be pegged against gold. So dollar was pegged at $35 per ounce to gold. Now, back then, once the Bretton Woods system was in place, gold storage worked very similar to how we have our currencies today. Gold was stored in banks, and if we had to collect or access our gold storage, we had to go to these banks and we had to hand over our dollars and currencies to collect gold in exchange for them. Then we move on to so this was the gold standard system, which was followed through 1970s till 1970s. The system did look very good until there was a little situation of a stagflation that hit US. So this was in the 1970s, early 1970s, where stagflation is a situation where there is very high inflation, there's very high unemployment, but there's not a lot of economic activity. So this situation had hit US mainly because dollar was the only peg to gold, and because of this, and because US was a global currency, US started receiving a lot of foreign investments. And this had led to a stagflationary like situation where inflation was high, but there was no economic activity. So to tackle this, what President Nixon had done was Earlier, they had pegged gold at the rate of $35 per ounce without too much of news, or he very quietly started increasing the price of this peg. So first from 35 to he increased it to $38 per ounce. Then he increased it to $42 per ounce. But once this news got out, this was initially done very quietly. Once this got out, this was not taken very well globally. People started protesting this, and neither did it control the US stagflation situation. So what Nixon did was he abandoned the Bretton Woods system. So from here on, gold was not eh, it was not pegged to any currency. In turn, dollar was the primary peg that was used against all global currencies. So that's the system that we follow today. So today, gold is not pegged to any currency. Gold is purely seen as an asset, as an investment, as a utilitarian metal, as we wear as jewelry. So most currencies today are pegged to the dollar. While gold today is not followed as any primary currency or it's not pegged to any, it has played a very big role in uh, stabilizing the financial system. And oftentimes it has been used as a primary asset, which central banks have used to stabilize the financial system. So this is about gold. So one question for the audience as we move ahead. Then we can move to the next and the next one. So where does all the gold come from? So which country do you think mines the most gold? You can enter your answer in the chat box. Okay, I see South Africa, USA, Russia as one, China. Okay, I see mostly towards South Africa, USA, and Russia. Okay, now we're seeing more of China. The answer is actually China. So they're again leaders in the lithium ion space as well in mining. They're also the leaders for gold mining. So China is number one. Closely followed by that is Russia and Australia. So now South Africa was mentioned by a lot of you guys. South Africa actually did dominate the gold production industry for almost a century. They started out in 1880s and till they're still a big contributor to the gold production industry, but their gold production peaked in 1970s. After that, they have not been contributing much to the gold production industry. So this hindrance of gold production for South Africa has mostly been because of the temperature that they have, because of skill shortages, because of the costs that they have attached to electricity, logistics. So this has made it mostly unfavorable for the mining industry to continue in South Africa. So in this chart, we don't see much about India either. There, it on in even in the rest of the world part of it, we don't see India. But there's actually this is mostly because India has been a net importer of gold. Almost 95% of gold's demand in India has been met with only imports. But there is one famous gold mine that we all might know. It's not active right now. It was closed down in 2001. Any guesses, guys? You can again use the chat box here. All of you, I'm sure, know it. You guys know the name. A clue is that it was a movie. Yes, all of you got it. Kolar Goldfields. That's right. It's in Karnataka. It's not operational today. They closed it down in 2001. So Kolar Goldfields faced a very similar situation to what South Africa had faced. Again, temperature, costs attached to it made it very unfavorable for mining gold. Right now, mining is actually a thriving industry globally. Companies over the last decades have started doing very well. They've become cash flow positive, but India is yet to make use of this trend. So the biggest or the only active gold mining company in India today is called HGM, and their output for 2023 was only 1.4 tons of gold. This is less than what they had mined out back in 2013. So in 10 years, the output of gold in India has actually reduced. It has not even increased. So, like I mentioned earlier, most of India's gold demand has been met with imports only, 95% of it. So, an interesting data to note is that in 2024, in FY 2024, India had imported around 795 tons of gold. So that's almost the yearly output of China, Russia, and Australia combined. Okay, now we can move on. So I'll be passing it on to Samyuktha from here.
Thanks, Vinu. I think that was quite interesting, like how we've looked at gold as an investment and how it's historically had a lot of economic importance and where we are in terms of where today's gold comes from. So I think then it kind of becomes important to talk about, okay, you have this asset that has always had importance in an economic context. So how do you actually value it in today's world? Because we are heading into a new era where gold is seeing a resurgence. And so I think we can broadly break it down into four factors, right? So you have supply, you have demand, you have utility, and you have the market cycle. These are the four components. Sorry, is my voice breaking for everyone? Okay. Just great. All right. So then I'll just carry on. If it's breaking, then I think there'll definitely be a video recording and maybe you can catch that. Okay. Thank you. Good. All right. So you have how do you actually value an investment like gold? These four components of are what are going to help us give us some kind of framework to decide how this is going to work, right? So first, in terms of supply, I think Vinu has spoken about where the world's gold comes from. And from another supply perspective, see, we need to treat metals like gold and silver slightly differently, even though we tend to bucket them in the metals category together. One, because let's say silver has some recycling value. That is, people do recycle silver and then use it. But in gold, you don't really have too much of that happening. And from a utility perspective, also, silver has a lot of industrial applications. Specifically now, I think the hot topic of where silver gets applied is in solar panels and all of that. So there is definitely some utilization for silver. Whereas in gold, on the technology side, there are some applications, but it's very, very minimal. It's not at the scale or level of how silver gets utilized. You see gold primarily being utilized in jewelry and not anything else. So that's where we are on the supply side, right? As well as utility. Now, if we come to demand, uh, the interesting thing is, of course, there's been demand for jewelry, but you also have in gold as an investment, right? Which in the form of ETFs or funds or physical gold as an investment, that is another source of demand. And the third and probably most important thing is central banks. So the trend that has changed in the last 5 to 10 years is that you're seeing uh, central banks sort of demand more, increase their demand for gold. And this is also correlated with headlines where you see reserves being increased. And again, this is at the back of the historic context that primarily a lot of trade was settled globally at the dollar level. And then once you had the Russia Ukraine conflict, it suddenly became evident to a lot of countries that okay, maybe the dollar is not the safest and most liquid asset anymore because during that conflict, the US kind of froze all of Russian dollar denominated assets. And when that happened, that became a warning sign to other countries that okay, overnight this kind of thing can happen. And then trade started happening in bilateral agreements, right? So you had trade getting settled between two countries at their exchange rates. And also now gold becomes this neutral currency or a neutral instrument through which you can look at settling trade as well as valuing a country's currency as well. So now you've seen central banks show up on gold. One, because of the fear of the dollar, but two, also because you've had the dollar strengthen for quite a while. And as we know in markets, everything that goes up also has to come down. So there is a concern that dollar devaluation can happen at some point, given that the US has been very proactive in sort of spending and printing money. And this has happened consistently for a very long period of time. So somewhere there has to be a valuation re-rating that occurs, right? So these are the things that have driven demand in terms of gold. We've talked a little bit about utility, and I think that part has covered. So now we move on to the market cycle, which is basically what is going to teach us how gold works, right? So if we look at how gold is as an instrument, you will see that it's not very linear, right? So we have, say, 2010 to 2023 data. So that's about 14 years of data that we have. And I want to break this down into three parts, right? Where we look at this in terms of cycles. And so what I'd like you to pay attention to is the yellow boxes, because the yellow boxes are essentially your gold boxes, right? And the number below that tells you the percentage return for that particular calendar year. So if we look at 2010 to 2024 as one long cycle, any guesses on what the compounded annual growth rate for gold has been? Uh, Feel free to type it in the chat box if you want to take a wild guess, right? So keep in mind that the number is like a percentage based return. 2 to 3%. Okay. Any other guesses? 8%, 11%, 10%. Great. So the number is actually closer to 9%. It's about 8.77 for this entire period, right? And you're not wrong. There are periods where gold return has been 2 to 3%. Specifically, if you've looked at, say, 2012 to 14, you've made 12%, you've lost 18%, then you made 2%, your return would have been pretty weak. And if you add 2015, another year of negative returns, you would have definitely arrived somewhere there. So there are phases where you can have bad returns. So if you started in 2010 and you got out in 2017, right? That's first 2 years of an up market, most of the down market, and then a revival of sorts. Then your CAGR in that phase was only 6%. Then, if you move to 2018 to 2024, which is the last cycle, a lot of people have typed 10 to 12%, 11%. That's the kind of return you've made in the last 5 years or 6 years. Because the CAGR return at this point in the cycle has been closer to 12%, right? So clearly, when we start our investing journey in gold, actually makes a difference to how much return that we can make. It's not like a linear asset class like fixed income, where more or less you're going to be in the range of 7% plus or minus 1%, depending on how the cycle is. Here you can have periods of negative return and deep negative returns, right? Negative 18% is not a joke. That is equity level of volatility in gold. So if we are looking at where we are in the context of the market cycle, which is an important question to address. One, we are moving into a newer economic order worldwide, where there is increased dependency on gold for financial stability of economies. You're seeing central banks actually lean into this trend and pick up more gold and build gold reserves. So you are seeing higher demand for gold. You also know that supply is constrained largely because, like Vinu mentioned, this is an activity, there is no recyclable, or there's a very small recyclable market for gold. So pretty much everything has to come from fresh production, right? And whenever you have mining as an activity, there are lags in terms of how that production actually plays out. And if we look at how global mining companies have fared in this cycle, they have been through a period of stress. They did have to deleverage their balance sheets, get debt free, or reduce their debt significantly, and then work on all of this. And in this, and at this point, they've still not been very profitable, primarily because inflation has been quite high. So that has eaten into margins. And now you're heading into a phase where wage growth has stabilized, gold prices are increasing. So from a miner's perspective, and production is also sort of improving. So now here we have to look at capital allocation and how much supply comes from the mining side. So with that, like we'll move on to the next thing as why should we allocate to gold at all in today's market, right? So Vinu talked about how we are at an all-time high, gold prices have shot up, and we do need to look at is this the right time to buy? Because we have seen from a historic perspective that returns don't always need to be positive, right? So let's build a case for the shiny metal. Okay, so if we look at gold's performance from 2000s to 2023, let me jog this a little further. Where do you think we've been? Do you think we were in the 3 to 5% range, the 5 to 8% range, the 8 to 11% range, or higher than that? Okay. So 8 to 11, 5 to 8, more than 11. Nice. Lot of good guesses here. All right. So the answer is actually C, 8 to 11%. So those who got B as well, I'll give it to you because the return range was actually 8.5%, right? So we're very clearly in that borderline territory of being somewhere between around 8%. Okay. So now when we look at how this is going to be a new era of investment performance, right? Let me break this down. So from 2000 to 2011 or so, you had a really bullish phase for gold, and your CAGR returns were almost 17.5%, right? And then you had a phase of contraction. So when you have such stellar continuous performance over a long period of time, you know that in any asset class there has to be a revision in demand as well as valuations, right? You can't sustain bubbles or interest in any particular asset class beyond a certain point. So then you had a contraction in valuation. So if we remember that colorful chart also that we showed you, you lost about 7% on a compounded basis between 2011 and or rather 2012 and 2015. And from 2015, we've actually been on an upward trajectory of again almost 11% compounded growth, right? So, and this is based on gold price, INR prices. I'm not looking at gold as a global investment. Based on rupees every 10 grams, this is how we've sort of arrived at these figures. So when we look at this, we're still in that phase where gold has a lot of runway in terms of performance. Uh, Primarily because a lot of macro factors are moving in favor, and secondly because of the way global trade and global activities are actually reorienting themselves. So let me give you 5 brilliant reasons to consider gold in your portfolio allocations today. So firstly, gold acts as a store of value. The idea being that if you own 10 grams of gold or if you own 100 units of an ETF or a fund, then that is always going to be exactly what it's valued, right? This is a commodity. If you even if you ever go to a jewelry store, they're always talking in terms of grams. You are not talking in terms of price, right? So whether there's inflation or not, gold is still gold, and that is how it acts as a store of value. The second thing is in terms of security, you cannot, there is nothing that is universally acknowledged as a good investment like gold, right? There is nothing that compares with gold in terms of security and acceptance. Um, and in terms of quality, also today you have, see, previously there was always this question of, okay, if I get something, do I know how pure it is? Will I have any problems in valuations? Today, that is not really like an issue that people have to deal with because largely you get certificates if you're trading in physical gold, and you have very reputed stores that you can go to. But even beyond that, because ideally, whenever you have physical gold, you have to decide how you're going to store and manage that asset. But in digital gold, it is all up to a certain standard, right? Like you have 99% purity in your EPFs as well as your mutual funds. And when you look at that, then there is a sense that, okay, uh, this is how it's going to work. And after that, if we look at point number four, which is diversification, gold has a lower correlation with equity and fixed income, which means that from a portfolio allocation perspective, if equity and fixed income don't perform for you, gold can perform for you because they actually tend to move in opposite directions and not necessarily in the same direction at the same pace. Uh, so this is from a security perspective of how you need to structure your portfolio, gold can add value to your wealth creation journey. And lastly, if you're looking at it as a utilitarian asset in terms of if you want to buy something in gold, then that also works. Uh, Ideally, like if you're going to spend, then today if prices go up in the future, you are going to be spending less today than you would be if you wait a year or two and prices move up. So these are five brilliant reasons. And in terms of what we mean by utility also is, let's say you have specific goals in the future that require gold, right? Sometimes if there's a wedding in the family, there is a need to plan purchases that involve, say, jewelry or something else that is set in gold. If you make an investment today and you wait until that gold arrives, then you just transfer your assets, you experience the appreciation, you get the same value because you know that this is what you're going to look at or this is your budget. And at the same time, you're doing a one-to-one transfer where you're getting the same kind of price, right? So this is the way that we need to structure um, your portfolios in terms of planning for gold as an allocation. So moving on, I think we need to look at how opportunity is knocking on our doors today. So first is there is less trust in fiat currencies. That's partly why crypto has taken the US by storm. Ideally, because people have felt that, okay, if you can just print as much currency as you want, then does currency have any meaning at all? Which is a question that market participants have been asking. And so that trust that, okay, money can be printed for anything is falling. And the one alternative to that, of course, is gold today. The second is what I've been talking about throughout, which is in terms of increasing bilateral agreements. So countries are no longer negotiating through dollar terms, they are negotiating with each other on their own terms, ideally being priced through neutral assets like gold. And then we have this trend of central banks stocking up. And the last thing that we've talked about is last mile disinflation. So we've been in an era of high inflation for a while, and now we're heading into a phase where inflation is actually moving towards more tolerable levels, but not towards the end target. So if we see where the US is in terms of how this is positioned, they are closer to 3%. They want to come to 2%. If we see where India is, we've been closer to 5%, we want to move to 4%. And this last 1%, right, we have come off highs of like 8, 9%, and then we've tried to bring it down to these numbers. But this last 1% is actually proving to be more challenging than the previous 5%, etc., that we've managed in terms of disinflation. So even in the RBI's latest commentary, the thing that they have talked about is that this um, disinflation has been uneven, and not at an sort of set pace, right? So you're having a very varied pace in terms of how that disinflation is happening. And the last is in terms of capital mobility, which is essentially now with the changes in the budget, where you've had your import duty being slashed on gold, you are now allowing people to use their existing gold as assets to create some liquidity and wealth within the family. You do see that from an entrepreneurial side, that is typically how it used to work in terms of being able to get a gold loan, etc. That's what families would do. But this has also encouraged investors to look at gold as an asset class after the tax changes for how gold will be taxed. So let's just quickly answer this question before we move on to Q&A, which is who should actually be investing in gold today? So if you feel that you have too much of your savings in equity markets, that is a good enough reason for you to diversify with gold, right? So if that's the kind of person that you are, please think about making an allocation. And then if you are someone who's actually been worried about market volatility and you're wondering that, okay, if equity markets are not going to perform for a couple of years, then what do I do? And if there's this decline in trust globally across economies, then I think it makes sense to have an allocation to at least manage that fear as well as make a winning investment choice. And the third one is like if you want to beat inflation and you want to protect the value of your savings, we talked about how gold is a store of value. So, as a counter to inflation, there is a very good case for you to look at gold as an investment. And the last is if you want to save for expenses in gold. So if you're looking at a situation where you have an expense and it's going to be to buy gold at a future point in time, we've seen it, especially if your goal is very far away, then we've seen these cycles, right? We've looked at 2000 to 2024, a 24-year cycle. We looked at 2013 to 2023 again. So all of these are longer periods where we've seen the performance of gold. And if you have these kind of sort of timelines, then it makes sense to look at gold as an investment. So what are the ways that you can invest in gold today? I think the easiest method is for you to look at a gold mutual fund. Per the latest budget, the holding period for gold mutual funds to become long term is 2 years. So that's 24 months. The long term capital gains rate is 12.5%. The next option is for you to look at gold ETFs because ETFs can again give you the same level of purity as a fund. Maybe in terms of liquidity, there can be a slight difference, which is more in favor of the mutual fund. But ETFs are also great. The holding period here is 1 year, same rate at 12.5% for long-term capital gains. If you have a sovereign gold bond, then there are no capital gains, but also exiting, entry, etc., is not as easy. So you don't have the same level of liquidity, and you do earn some interest on the SGB, right? So taxation, if you hold to maturity, no tax impact. If you are selling in between, I think you can exit only after the fifth year, then it's 12.5%. So for coins, bars, and jewelry, you need to be careful about making and wastage charges because that can really eat into your returns. But ideally, that's uh, also going to attract a 12.5% tax with long term being 2 years. So we've reviewed all of your opportunities. So let's just open up for Q&A. I already do see some things typed in. Let me just go through the Q&A section. Sorry, it's taking a bit of time to load.
We have a question comparing gold with silver, where the question is about silver having more of use in terms of factory purposes and ornament. So it's true that silver has a lot of industrial uses compared to gold. So lately we've been seeing the trend of how silver has been a component. So all our laptops, all our phones already have a very small component of silver, all our electronics. Now we're also in the trend where we're seeing solar panels have silver in them. We have EV batteries have silver in them. It is true that there's a lot of factory purposes that are attached to gold, sorry, attached to silver. But I think we'll have to give it a little more time until we see even so. EV is a very big theme that's being spoken about with in terms of silver usage in industries, but there's still no clarity on what kind of battery system is going to be used. So it is true that if silver is going to be a big component of these manufacturing processes, then silver has bigger potential because the mining for silver is also smaller compared to gold. So that is why usually when you see price movements of silver and gold also, silver movement is usually tends to be more volatile because of the supply that silver has in the market. So if silver use is going to be much higher, then potential is higher, but we'll have to give it time until we see more evidences on how much more silver can be used in industries. Sam, you have anything to add?
Yeah, sure. I'll just add one point. Like, see, both are good investments, right? Because broadly, the idea is that they are precious metals. Their correlation with traditional assets like equity and fixed income are lower, meaning that if you add that to your portfolio, you get a better risk-adjusted return on your overall portfolio. Silver tends to be a lot more volatile than gold. So that is something you have to factor in. So on the upside, that can be higher. On the downside, also that can be higher. So based on your risk appetite as well as your entry valuations, I think that is something that you need to monitor. And definitely, it's not uh, an either or. In our case, we look at both as complementary forces in the portfolio. All right. We have a question on SGBs. They are trading at a premium of 4 to 8% now. Is it still worth buying? So, one thing, like you would need to do a little bit of math to figure out whether it's worth buying, right? Because ultimately, the easy part about valuing gold is it's in grams. So we know that if you're paying more, you know what price you're paying for gold. And then you also have to look at when does that SGB mature, because one of the reasons why there is no capital gains on SGBs is broadly because there is no idea of at the time of maturity whether the investor will make a positive or a negative return. Now, if you are not going to make a positive return, right, or if you feel that the odds are fairly low after paying this premium, then it doesn't make sense because there is a forced redemption on a particular date, which will happen to you, and it's also not a very liquid market. So for you to enter and exit SGB in the secondary market is quite tough because only individuals and HUFs are allowed to participate in that space. So somebody has to be willing to sell it, and it's really a seller's market and not a buyer's market. So I would suggest do the math and see if you're getting a good deal. If you are getting a good deal, then you can go ahead, because see, there's also this added return that you're getting 2.5% as interest every year, right? So that is something that you need to keep all of these numbers in mind while deciding whether it's worth it or not. Okay.
So there are two
Considering
more
that,
questions. Sorry, there are
yeah.
two more questions on SGB itself. One is about when the next issue is. There is still no clarity on the next issue. So we'll have to wait for an announcement from RBI. And the other one is if SGB is bought from the secondary market and if held till maturity, does it carry the same tax exemption? Yes, if it's bought either on primary or secondary, if it's held till maturity, it does carry the same tax exemption. There's a
Okay.
question on central banks stocking on gold. Sam, you can take it.
All right. So, see, I don't think the idea is to weaken the USD. I think it's been more of a protectionist measure Primarily because on one side they're worried about inflation, on the other side they're worried about having too many dollar denominated assets. See, there's no shift, right? Like it's not like there's a de-dollarization or like the dollar is no longer the reserve currency of the world. You do have a lot of trade happening in dollars. What is happening is that there is a shift in preferences, and there are bilateral agreements which are coming up, which have not happened for a very, very long time. So I think it's more from an inflation perspective, because if you have very high prolonged inflation, then even dollar denominated assets may not grow, right? Whereas in periods of high inflation, gold value will go up. So I think it's been more of a protectionist action rather than an a more aggressive or that kind of action to devalue the dollar or something of that sort. View on capturing this opportunity through gold miner funds. I think this is something we've been very vocal about. If you've attended our previous webinars, also Harshil has extensively spoken on this subject, and that is something that we can definitely look at. But again, we need to look at cycles. This is something that we are positive at this point in the cycle. And of course, like Vinu mentioned, we don't have gold mining companies in India. What we have are there's just one company, so we have to look at more from a global perspective. Yes, I think SGBs bought from the market also carry exemption till mature. If it is held till maturity, the person selling is has to pay long-term capital gains. That is clear. Okay, why should we invest in mutual funds when ultimately they buy ETFs? Good question. So there are a couple of reasons. So one is in terms of settlement, everything happens through the AMC itself if you're in the mutual fund. Otherwise, you'll have to go through your broker in the market directly. The second thing is if you have a demat account, then you can transact in ETFs. If you don't have a demat account, you need to transact in mutual funds. So those are the two reasons. Uh, one in terms of settlement liquidity, and the other in terms of operationally how you have your investment structure. All right. So there are a couple of questions here. Now government has lowered the import tax on gold and silver. Can we go along physical gold or sovereign fund for investment? Which one has lower tax on long-term capital gain? With the changes in the budget as well as the reduction in import duties, there's been more or less a standardization on tax, long-term capital tax rate, which is 12.5% for all the gold investments. Depending on whether you're doing physical gold or a mutual fund, it will be 2 years as a holding period. If you're doing the ETF, it will be 1 year as a holding period. So we don't discuss any specific products on our webinars. We don't think this is an appropriate platform for that. But of course, if you're interacting with anyone from our team, we can get on a one-on-one call to understand what would suit you. Mining costs increase and less yield makes gold price high. If yield is negligible in yield and price will be exponent, what is your view on this? Yeah, so it's basically a commodity, right? So if your supply reduces because the yield is less, then the price will move up. So but eventually what happens is, see, gold doesn't have much utility as such, right? It's not like, let's say, rice or wheat where people actually consume this asset. So what will happen is if you have less yield, then discretionary spending in terms of jewelry and all will reduce quite significantly because it will just become too expensive for people to participate on a retail perspective. So, but again, like the other things in terms of investments as well as maybe in terms of central bank stocking up, that may not actually reduce that much. Okay. Next question. considering debt and gold to diversifying the portfolio and risk and rewards associated with it. Interesting. So we are positive on both fixed income and gold at this point. We look at fixed income as a very good source of liquidity and flexibility. We look at gold as something that can also be a performing asset in your portfolio. We are not looking at fixed income as something that can generate a lot of returns or replace equity from a return perspective. We are looking at it more from a risk management tool perspective. Gold, on the other hand, can, in addition, while it can be volatile, it can also be a performing asset class in your portfolio. So, see, we cannot project what the next 5 year return in gold will be. But what we are saying today is that there are enough drivers in this market to create value for gold and to sustain this kind to sustain performance, maybe at this level or at a different level. But only now people are starting to talk about gold as an investment, right? If we look at 2018, nobody was telling you to buy gold. People were looking at small and mid caps then because 2017 that had performed really well. Uh, and now you've had one cycle of performance there. Comparatively, you've not had very high performance here. You still have inflation as a problem. You still have certain macroeconomic uncertainty. So there are a lot of positives in terms of what is driving gold performance. This again is a very subjective question, right? So that's why we said we need to look at certain metrics. You can't have like a price to earnings or those kind of valuation metrics when it comes to gold. What we have to do is we need to look at supply demand. We need to look at cyclically where we are in this asset cycle. We need to look at gold relative to other asset classes, right? And we also need to look at macroeconomic factors. Through that, you can have some level of valuations in terms of if you're able to project what is the required supply versus what is the what is the required supply versus what is the available supply, and then I guess you can try to arrive at a valuation based on that. Appreciation support gold business like jewelers, gold lenders. Is it a good idea through this way? So, if we're looking at gold lenders, right, we need to understand certain things. Or okay, let's first look at jewelers because Indians are very price sensitive. If the price of gold goes up, the volume of sales will reduce. If the price of gold comes down, the volume of sales will increase. So we need to look at both together. We need to look at volume growth as well as price growth. If price growth is always going to be set off by volume growth, then you will have a difficulty in actually seeing valuations or the business growth expanding. And so that is one thing. So if you're looking at that, it's not a very simple, oh, gold price will increase, so their profits will increase. It's a much more sensitive market. So we need to look at people who are able to not take a volume hit when the price changes.
So consumers of gold also play a big role in determining whether investment in gold jewelers is a good idea. So because gold price, while it is one factor that determines whether people are going to buy gold or not, the general sentiment towards gold as a jewelry has itself taken a shift. So if you compare maybe your earlier generation, the amount of gold that they used to purchase for marriages or functions compared to what they do today is completely different. So we can't determine it purely based on gold appreciation. There are much more factors that are attached to this.
And when you look at gold lenders now, what happens is, again, there you need to see how they're managing, right? Because you put in gold as collateral. So what is the loan to value? Now, if somebody can close their loan at so if I have submitted gold for valuation, I mean, as collateral 2, 3 years ago, and now the gold prices have moved up, that has not been revalued. So that is also something that you need to take into consideration. How are these lenders looking at older liabilities, and how are they going to manage newer liabilities? Also, we need to see this in a cycle of few years. So if you start getting gold loans at the peak of the cycle, then you're actually providing more loans than you have collateral for when the prices change. So we need to look at cyclically how these businesses have done, and not just today because they are in that line of work that we might get something at a very attractive valuation. So we don't have this minimum holding or maximum holding concept uh, at a broad level. What we try to do is work with each investor to understand from their risk appetite and goal targets what is suitable for them, right? So if you have to diversify into gold, silver, then I guess you can start with paring down equities. Again, based on your risk appetite, right? Like if 80 is appropriate for you, then you can look at maybe paring it down from fixed income. If 80 is not appropriate for you, then you can look at reducing from equity. So again, this is something, these are the kind of conversations that if anyone else has this also, please do reach out to us one-on-one. I'll just leave our number here. It's 967770000613. And this one-on-one conversation can actually give you more clarity on what you need as well. Thanks. If we have any more questions, happy to take it. Otherwise, we're really happy that you made it to our webinar on Saturday, and we look forward to talking to you more about different subjects in the future.
Thank you, everybody.